In 1923, a Florida land developer named Charles Pontes sold swampland to thousands of investors with a simple promise. Buy now, prices only go up, you can't lose on real estate. Within 2 years, a hurricane hit, the market collapsed, and most investors lost everything. Charles Pontes disappeared. The state of Florida didn't recover economically for years. Now, I'm not saying rental property is a Ponzi scheme. It isn't. Real estate is a legitimate asset class with a genuine track record. But the version being sold to middle-class Americans right now, the rental property as passive income machine, the path to early retirement, the inflation hedge that pays you while you sleep, that version has a gap between the marketing and the math that is quietly costing people years of their financial lives. My name is Larry, and I've spent time running numbers on real estate versus stock market scenarios that most real estate influencers don't want you to see. By the end of this video, you'll understand the true all-in return on a typical rental property, the hidden costs that almost never appear in the pitch, and how the same capital deployed differently could retire you years earlier. Not because real estate is always wrong, it isn't, but because most people buying their first rental property in 2025 are doing it with incomplete information and paying for it with time they can't get back. Let me start with the pitch because you've heard it. Maybe from a podcast, maybe from a coworker who just bought their first rental, maybe from an Instagram account with a Lambo in the thumbnail. The pitch goes like this. Buy a property for $300,000. Put 20% down, $60,000. Rent it out for $2,000 a month. Your mortgage is $1,400. You pocket $600 a month. That's $7,200 a year. On a $60,000 investment, that's a 12% cash-on-cash return. Meanwhile, the property appreciates. In 10 years, it's worth $450,000. You've built equity and generated income simultaneously. This is how the wealthy build generational wealth. It sounds airtight. Let me show you what it looks like in practice. Meet Greg. He's 38. He saves up $60,000, buys a $300,000 rental property, and starts collecting $2,000 a month in rent. His mortgage payment, principal and interest at a 7% rate in 2024, is $1,596 a month. Not $1,400 like the spreadsheet said. Already the math is tighter, but the mortgage is just the beginning. Property taxes. On a $300,000 property, depending on location, roughly $3,000 to $6,000 a year. Call it $350 a month. Insurance. Landlord insurance, not homeowner's insurance. Typically 15 to 25% more expensive. Call it $150 a month. Maintenance and repairs. The standard rule used by professional property managers is 1% of property value annually. On a $300,000 property, that's $3,000 a year, $250 a month, and that's in a good year. A new roof is $12,000 to $20,000. A new HVAC is $5,000 to $10,000. Vacancy. The national average vacancy rate is around 7%. On $2,000 a month in rent, that's $140 a month you need to budget for. Property management at 10% of monthly rent, $200 a month. If Greg doesn't want to take the 11 p.m. calls himself. Total monthly expenses, $2,686. Monthly rent, $2,000. Greg is losing $686 a month on a property he was told would generate $600 a month in passive income. The gap between the pitch and the reality is $1,286 a month. He is not building passive income. He is subsidizing a tenant's housing while taking on liability, complexity, and a second job. This is not a rare outcome. A significant percentage of first-time rental property owners in high-cost markets report negative cash flow in the first several years, particularly those who purchased after 2020 when both property prices and interest rates rose sharply. The influencers selling the rental property dream built their portfolios in a different rate environment. They are teaching you to drive by showing you a map of a road that no longer exists. Now let's look at what Greg's $60,000 does in the stock market instead. Same $60,000. Invested in a low-cost S&P 500 index fund at a historical 7% inflation-adjusted annual return. No tenants, no 11 p.m. calls, no roof replacement, no vacancy months, no property manager, no liability, complete liquidity. At 10 years, Greg's $60,000 has grown to approximately $118,000. At 20 years, $232,000. At 30 years, $457,000. From a single $60,000 investment. No additional contributions, no leverage, no management. Meanwhile, the rental property required him to subsidize $686 a month in losses, spend time managing it, hold illiquid capital, and take on legal liability for a tenant's living situation. Even accounting for appreciation, if the property grows 4% annually to $444,000 in 30 years, his equity after paying off the mortgage is roughly $294,000. Less than the stock market's $457,000, with dramatically more effort and risk. The leverage argument is where real estate proponents push back hardest. You put in $60,000 and control a $300,000 asset. That leverage amplifies your returns when prices go up. When prices go down, leverage amplifies losses with equal force. The 2008 housing crisis was a leverage crisis. And unlike a stock market decline, notice how painful but purely financial, a real estate decline can leave you with a property you can't sell, can't rent for enough to cover costs, and can't walk away from without destroying your credit. Liquidity is the hidden cost nobody puts in the spreadsheet. If Greg's stock portfolio drops 30%, he can hold, wait, and recover. If his rental market collapses and he needs to sell, he's navigating a process that takes months, costs 5 to 6% in commissions, and may close at a loss precisely when he needs the money most. Here is where real estate does make sense, because I want to be precise. It works in markets where rent significantly exceeds carrying costs. It works for people who have the skills to do their own maintenance and genuinely reduce the cost structure. It works for experienced investors who analyze deals with realistic expense assumptions. And it works as a diversifier for people who already have substantial stock market wealth. What it doesn't work for is a first-time buyer in an expensive market using all of their investable capital as a down payment, relying on influencer math that excludes half the real expenses, and believing the words passive income without interrogating what passive actually means. Here's the 5-step framework for evaluating a rental property, honestly. Step 1. Run the full expense stack before you run a single return calculation. Mortgage at current rates. Property tax at the actual county rate. Landlord insurance. A 1% annual maintenance reserve. An 8% vacancy allowance. Property management at 10% even if you plan to self-manage. Your time has value. If the rent minus all of those expenses is negative, the deal does not work. Move on. Step 2. Calculate your opportunity cost explicitly. Take the down payment and run it through a compound interest calculator at 7% for 20 years. That number is what you give up in liquidity and simplicity. The property needs to beat that number on a risk-adjusted basis to justify the complexity. Most deals, evaluated honestly, do not. Step 3. Stress test the vacancy scenario. What happens if the property sits vacant for 3 months? What if a tenant stops paying and the eviction takes 4 months? The average in many states? Do you have reserves to carry the property through that without missing your own bills? If not, you are undercapitalized regardless of how good the deal looks on paper. Step 4. Separate appreciation from cash flow in your analysis. Many people justify negative cash flow with expected appreciation. That is speculation, not investing. Appreciation cannot pay your mortgage in the months when the property is underwater. A deal that works only if prices keep rising is a leveraged bet on a local housing market, not a real estate investment. Step 5. If you still want real estate exposure, consider REITs first. Real estate investment trusts let you own a diversified portfolio of income-producing properties with full liquidity, no management responsibility, professional oversight, and historical returns that match or exceed direct ownership. Available inside your IRA or brokerage account. Not glamorous. No social media content. But for most retail investors who want real estate in their portfolio, a significantly better risk-adjusted vehicle than a single-family rental in a market they don't deeply understand. Here's what I want to leave you with. The rental property dream is sold so aggressively because it is genuinely aspirational. Owning something physical, collecting rent checks, building an empire. These images tap into something deep, especially for people whose parents built wealth through homeownership in an era when that worked straightforwardly. But the world has changed. Interest rates changed, purchase prices changed, the math changed, and the people selling the dream in 2025 mostly built their portfolios in 2012 and 2015 when the math worked differently. Or they make money teaching real estate investing rather than from the real estate itself. The goal was never to own rental property. The goal was financial freedom. And the most reliable path to financial freedom is the one where the math works, the risk is manageable, and the asset compounds while you sleep. For most people, that path runs through a brokerage account, not a second mortgage. Subscribe if the numbers landed differently than you expected. And tell me in the comments, have you run the real numbers on a rental property deal? What did you find?